Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And it's post-election. And so Julia Lee will be talking on investing post the poll on Saturday. Adam Dawes of Shaw & Partners looks at 3 stocks that he reckons will go higher because of that Labor victory. Then Joe Masters of Barrenjoey Capital will look at the economy and ask the question, can it avoid a recession? And will it help stocks go higher? So it's Labor plus the stock market. Will they combined help stocks go higher in the year going forward? And then I'll start with Paul Rickard, my colleague from the Switzer Report, to talk about how he thinks the election will affect stocks and maybe are there any stocks worth buying as a consequence of it. But before that, let me show you a really interesting chart that came from Macquarie Research, looking at the kinds of companies that might benefit from either a Liberal, Labor, or possibly a Green influence Labor win. Have a look at this table right now. And so what we got here from this Macquarie Research is a whole bunch of sectors and companies that would benefit. And this was done before the election, of course, if either a Liberal Labor win came along or a Labor win with a heavy reliance on Greens. These companies here. Interesting that Worley is one of those. And Worley is a company that will feature in this show today. One of our experts really likes Worley as a consequence of it. But I think it's probably worthwhile having a look. Maybe you could even just freeze the screen on this and take down some of the names. These are companies that Macquarie believe potentially has some benefit from either a Liberal or a Labor victory. And I think it's very, very interesting. For his take on the election and how it might be sensible to invest as a consequence of Saturday's result, we have Adam Dawes of Shaw & Partners. Adam, thanks for joining us.
Yeah, it's good to be here, Peter.
All right, mate. Just generally, what was the feeling of the market's reaction today to the election result?
Yeah, I think the market definitely took it in its stride. We're up just around sort of 5 points when I left the desk, so we've still got a little ways to go. But yeah, I think the market definitely looked like they were comfortable with what was going on. Certainly some resource stocks did very, very well today, but I think that's got a lot to do with sort of more of the larger commodity cycle. But yeah, we did certainly see some interesting moves in the market as far as some of the potential policies that Labor might place onto the shares or the stock market or into the businesses, and some of those moved quite substantially today.
Okay, now I know you've got 3 stocks you want to talk about, but those ones aside, was there any outstanding jumps today that made you think, gee, this is interesting?
Yeah, I think certainly Labor has definitely been hanging its hat on the whole energy transition and potential that will certainly be one of their sort of key policies going forward. And certainly something like a Worley's did quite well today on the back of that. They're actually looking pretty good. And some of the healthcare stocks actually sat up pretty well also. So that was actually quite good. Probably be a little bit nervous about if Labor does decide to put an iron ore tax or a mining tax onto some of our larger miners. So potentially you might want to sort of look to some of those portfolio stocks and some of those miners that might be in profitability is just taking a little bit off the top here, as it has been a pretty good quarter for the resource stocks as well. And if something like that does come into action, you might see our market react negatively to that going forward.
Anthony Albanese was asked the question at the Sydney ACCI lunch about 3 or 4 weeks ago, and he said they've got no plans to change taxes. So if it's going to come, it's going to come in the May budget next year, and that I think would be in the context of a booming economy or a rebounding economy and a need to bring the budget deficit down. So I think we'll have some time before we start worrying about that.
Yeah, that's fair. I just think that we've had a really good run on these resource stocks over the last let's say last year to date. It's really held up our market only down sort of 6.5%. versus globally, the S&P 500 down 18 and NASDAQ even higher at 26 or 28%.
Yeah.
So yeah, it just it bodes just to potentially take a little bit. But you're right, this is going to take some time, and there probably will be a lot of noise before anything actually does start to happen. So just keep the ear to the ground on those, I think, Peter.
Okay, mate. Let's go to the stocks you talked about. First one on the screen is going to be GEM. That's G8 Education. It was up today. I think it was about 3.6% I saw before we came on screen. Why do you like this company?
Well, it's just obviously going to be one of the key policies that Labor's put through to their constituents is that they are going to look at education and potentially childcare. And that is going to be a big one for GEM, which will potentially get some more subsidies or get some more free money that will potentially come through. So the market's reacted a little bit to that position on childcare. And it just means that there's potential that could actually flow through. So market was just getting probably a little bit ahead of itself. I think it did go up high, but then sort of came back throughout the day. But that potentially is one of the benefactors of a new government that has just come in.
This company, it was about a $4 stock and it's now around about $1.19 or whatever. What happened to it? Why did it come off the boil?
Well, there's certainly a couple of things. One was that higher labour costs that had to come through because the previous government put in restrictions on that you needed to be degree qualified to look after children, and hence then they had to then charge more for the carers or the workers to actually take care of the kids. So that's the first thing. The second thing is also there's a lot of cost in getting a new childcare up and running, and then hence the property values of that, or to get that moving forward as well. That certainly has hit as well. And GEM, I think they came under a bit of fire because they were very much sort of local Sydney or Melbourne, sort of in the CBD kind of businesses, whereas they then tried to move outside of that and go a little bit further out of field, which wasn't successful for them as well. But really, it's the labour costs that I think that really hurt the business going forward. Okay.
Now, you mentioned Worley. Well, Worley. By the way, I should say GEM, the analysts think about 5.8% upside for GEM. But let's go to Worley now with that chart on screen right now. And here the analysts think there's 11% downside. But I guess you'd say, what would the analysts know?
Well, hopefully they know something. But yeah, look, I just like it because of this energy transition side of things. This energy transition is going to be huge. And as I said, Labor has really hung their hat on putting that as part of their overall climate change. They did come out to everybody and say that that's going to be one of their major policies going forward. And potentially a lot of people did vote on the back of that for them. But Worley is probably around about sort of 4 to 5% of its revenue now is all about in energy transition or engineering in the green space. But as we know, to get to that net zero by 2030 and 2050, that is really going to take a lot of money, in fact, trillions of dollars each year for that to happen. And Worley is in the box seat for that transition. They're looking to get around about 25% of their overall revenue in the next 2 to 3 years coming from that green transition. So oil and gas is doing really well for them. They've got this green transition or that sort of green tinge across the top of it. And I think it's a fantastic stock and looking pretty good. Never say safe, but it is a safer play with the tailwinds that it does have at the moment.
And let me say this to you, you could have added to your answer that those analyst calls were before the election result as well, because they wouldn't have had a chance to upgrade and change their price target. So, yeah, good reply and well done. I thought you're pretty good thinking on your feet then. Let's go to the final one. Always happy to help. Let's go to the final one, and that is APA. Now, tell my audience what APA does and why you think this is going to be a beneficiary of a Labor government.
Yeah, so APA is Australian Pipeline Trust. So basically moving gas from Moomba and the sort of major gas areas around the world, around Australia, through the pipelines to basically to the boats out of Brisbane or whatever, and then they go onto the boats and then they head off overseas. So APA is the pipeline. So in other words, they just take a clip of gas that's just moving through the pipelines going forward. The stock did rally, and in fact, quite considerably. I don't know if you've got that on the chart, but you can see that it did on Friday break out of its sort of a top end of that $11 or $12 price range. And really sort of broke out. And I think that was on the expectation potentially that this one would do well. It has consolidated a little bit today, so come back a little bit, which is fair when it starts to do some sort of those new highs. It's just seen as a very defensive business. So in other words, when things aren't going so well, this one is seen to be a little bit more of a safe haven. But I think that the energy transition, and it's obviously natural gas is one of those sort of pillars that they will be working on with Labor and to move some more going forward. But I think this is certainly one of those ones that will do well. It is at all-time highs at the moment, so I would be very cautious around here. It's got to do some work around that $12 mark before we can start to see it move higher. But it will benefit from a new Labor government going forward.
Okay. Well, as Chevy Chase said to his son, an American vacation. Good talk, Rusty. Good talk. Welcome to the program, Julia.
Thanks for having me, Pete.
So have you been sitting down working out what companies are likely to benefit from an Anthony Albanese victory on Saturday? Yes.
This election's been quite strange because I don't think it makes a huge difference to the market, and that's because there's been no major reforms that either party have been campaigning on. The main thing for markets, I think, was whether we were going to see a majority government being formed or a hung parliament. And it does look like Labor is going to be able to form a majority government. And that's a positive because we are seeing lots of changes going through the economy, lots of challenges like inflation, rising interest rates. And that just means the government of the day will have a bit more flexibility in being able to manage the economy. So it looks like a positive there. Of course, the big thing to come out of this election is the move to the teal independence, which is a huge swing towards climate change. So having a look at some of those green energy stocks, and look, Pete, you know I like stocks like Allchem, Pilbara Minerals, if you want hard rock Australian lithium, as well as Linus Resources. So I think those type of companies are also keeping one eye on China. And today we heard that Beijing has recorded the largest number of COVID cases so far. So in the short term, I think investors may have an opportunity to pick up some of these green stocks for the longer term portfolio, but it does look like Australia is going to play a bit of catch up with the rest of the world in terms of some of the green policies. But of course, a lot of those policies are also dependent on whether there can be supply of things like electric vehicles, with China still coming out of lockdown. So watching the COVID situation closely.
Have you identified maybe a childcare business that will be a beneficiary? Because there's a fairly big commitment to childcare, isn't it, from the Labor government? Has anything sort of crossed your research?
Yeah, well, G8 education is the big one in terms of the market, and it's trading just under 120 at the moment. So the share price has been doing very well of late. But I guess just having a look across the market, and it's been interesting what's been happening over the last couple of weeks. We have seen bond yields moderating and coming back down a little bit. So that talks of a shift in the short term, perhaps towards more growth orientated things and away from some of those more interest rate sensitive areas. So I guess if we have a look at the growth orientated stock that I like at the moment, you know I like IDP Education. Aristocrat Leisure came out with a very strong result as well. So that company is looking good. Of course, if you are looking for companies which are linked to interest rate rises for the longer term, these are stocks like Computershare, Hub24, also looking good in that space, as well as QB Insurance. But we are seeing a bit of a shift at the moment, but I feel like it is a short-term shift. And the big question for markets is whether the US does enter into recession. And I think that is going to be dependent on inflation, whether we have seen inflation peak or whether inflation does stay at these very high levels. And I think one thing that investors can watch to get a gauge of whether inflation has peaked or whether things are going to get better or worse is simply through oil prices. We see oil prices above 110 US a barrel. We know that inflation is probably going to stay pretty high. And that's because oil prices really filter into pretty much every product in our life that needs to be transported. So watching oil prices very closely for a lead indication of where the market might be headed.
Julie, let's go back to your comment around Beijing. Did you say that there was the biggest recorded number of cases? And what does that mean for the June 1 getting our lockdown prediction that we've been hearing?
Yeah, it's very hard because we know that while Shanghai is looking to come out of lockdown, Beijing, it looks like things are getting relatively worse there, and Hong Kong very much in focus as well. The big thing, I think, for the global economy is whether or not we see China abandoning the zero COVID policy. At the moment, there's no signs of that, and unfortunately, that means that economic performance is very much tied to the health performance of China. So watching that very closely, but also watching to see whether we are seeing a shift in terms of the manufacturing process. We know that China is the manufacturing capital of the world, but given what we've seen over the last few years, there are a number of big companies now looking to shift their manufacturing away from China to parts of Europe as well as other parts of Asia. So watching to see whether that's a more permanent shift and whether that gets a bit more demand going, especially from the commodity-based space. But I suspect that China, even though it's doing it pretty tough at the moment, what we are going to continue to see is stimulus coming through in terms of infrastructure and cutting of interest rates over there. So that should help to help support our commodities and resource space.
Yeah, which you like those stocks as well, don't you? The commodities.
Yes,
Okay.
I do. And look, I think it's important for investors at the moment to keep one eye on the short term versus the long term because things are shifting so quickly. There's lots of opportunities in terms of this space. But look, in terms of 2022 as a whole, I think commodities will perform well.
One last one, Julia. I've asked this of a number of people. Do you think Labor will have a better level of communication with Beijing, which might, in the end, benefit some of our exporters who have been slammed with tariffs in recent times?
Well, you've got Penny Wong there who has Chinese heritage. So I guess if you have a look at Labor, we'll have to wait and see. But it does look like there could be, I guess, a bit more smoothing in terms of the waters, although it depends on China's actions as well. It's interesting to see that Biden making comments that if Taiwan was attacked, that the US would look to protect Taiwan. So also watching that geopolitical risk because we know that things are changing pretty dramatically all over the world and these things are hard to predict. So look, it really does depend on China's actions as well and what happens around the globe.
Be interesting if Anthony Albanese sent Kevin Rudd over there because he's pretty good on Mandarin, but I don't know if he's all that good at schmoozing up to people. We'll have to wait and see. Julia Lee, thanks for joining us. Well, I want to check with my colleague Paul Rickard what he thinks the impact of the election might be on investing going forward. And also I want him to have a look at some of the stocks that were suggested in that Macquarie table as well. Paul, overall, the market today up and down, not really moving much at all?
Yeah, very small movement up, slightly higher movement in the US and the Aussie dollar against a weaker US dollar. So, look, a bit of a yawn from the market, I think. I think relief that it's over, relief that probably will end up with the majority government, which is going to be more workable. Yeah. But because I think so little's been said, there's been such a small target sort of campaign, Peter, there's not much to sort of point your finger at. There's not too many nasties out there. And it's going to come down to execution and their competence as economic managers. And there's not really much for the market to get too excited about at the moment.
Do you think foreign investors will like to see Labor get a majority so it can rule in its own right?
Yeah, I mean, I think that was probably the risk. I always expected a fairly low-key reaction domestically, but the risk was perhaps more offshore. People looking at, what is on paper at least a left-wing government, and foreign investors typically don't like that. But I think that's we've passed that test, because that's that's sort of
There's no big sell-off.
There's no big sell-off coming out of Asia, and I think if they were really serious, they would have got in there early, and then they'd be more comfortable now that there's going to be probably a very a wafer-thin majority. At least it means that it doesn't at least initially have to go and make a lot of deals to get form government.
Yeah. Do you think some investors might be thinking, maybe these guys will get along with President Xi a little bit better than Scott Morrison, and that could be good for some of our exporters?
Look, it's not going to do any harm, Peter. I mean, look, I think, there's something in that. And I think also they're going to spend money in sectors that perhaps are more in kiln with the stock market, and that's going to take a number of years. There's no pullback on defence. There's a slightly more openness, I guess, in our relationship with China. Proofs in the eating on that one.
Yeah.
And we're cozying up to the United States tomorrow, and there's nothing to get too concerned about.
And there's no promises of tax reform, which always worries investors when Labor starts talking about tax.
There's also no promises of new taxes, really, apart from the variable go back and let's make multinationals pay. Well, we know how many times that's been promised, Peter, and how effective that's been.
It's about as many times as every government has promised to reduce red tape for small business, and they never do.
Yeah.
Now, let's put that table back on the screen, and this is what Macquarie thinks are companies that could be affected by either Liberal or Labor policies, or the Greens. And Paul, is there any stock amongst them that you think, I reckon it's a goer under a Labor government?
Well, I think there are things that are going to go over the time. I mean, certainly we're going to see a focus on renewables. And that probably means money to help people in things like with transmission and with new development opportunities. How that translates short term to more profitability for those companies is unclear, but that's one area of focus. Secondly, Peter, there's a strong element here which is not up there on childcare. Yeah. So that means money potentially for the childcare operators. So G8's an example of that. But just bear in mind, that's still 12 months away. It doesn't actually, the new subsidy doesn't come in until the 1st of July 2023.
Yeah.
That's 13 months away.
Yeah.
So you're not going to see it in their figures until, the reporting in early 24. Yeah. Very hard for the market to get too excited about that today because it's not going to show up in the profitability. I think the other thing here, Macquarie's got an emphasis on things like manufacturing and obviously in batteries and so forth. I mean, that's all true. Whether that really shows up, I mean, I'm not sure that, some of those companies around, aluminium and gas and recycling, you're really going to see that translate to the bottom line.
Yeah. Notice that Aurora bobs up a few times. Paul, what do you think of that company in a sort of a Labor government?
Yeah, I'm not sure, Peter. I mean, I think that the challenge for any of the packaging manufacturers is as more and more focus is placed back on greener and cleaner packaging, it means they've got to change their processes, and potentially, ultimately the consumer wants to see less packaging, not more, and that makes it harder. So I'm not sure that's necessarily a winner for them.
All right, what about gas? Gas, you've got companies like Woodside and Santos. They're seen as potential gainers under that was actually under a Liberal win. So in a sense, they're probably going, if Macquarie's right, they'll be feeling a bit of pressure.
Yeah, I sort of think this is, I think I would say rather this is highlighting stocks that have, will feel the impact of political change of policy, not necessarily through higher share prices and not anything quickly. I guess, it's more state governments that impact companies like Woodside and BHP in terms of development approvals. Yeah. I mean, clearly the federal government's got to sign off on major projects, and I guess it's going to be harder for them to get in the long term, carbon intensive projects off the ground. Yeah. And so that has but that's an impact over many years, and that doesn't necessarily mean tomorrow the share price falls tomorrow. Yeah. it's all over from there.
Okay, so if you're put on the spot, you'd probably say a company like G8, which is GEM, but it's going to take time. You're not going to.
Yeah, I think look, the areas to look at are education, because education and healthcare. You know that over many years.
Yeah.
You look at the polls say, who do Australians trust most to help them with education and medicine? They trust the Labor government because they spend more, right?
Yeah.
So anywhere you've got to go extra government spending, got to be good for some winners over there over the long term. Recycling, yeah, I can see that that's going to work, and it's going to help some of the renewable energy operators. But there's most of the listed companies there, Peter, have disappeared. It's all been swallowed up by some
one
people.
last thing, we know that Anthony Albanese made a big promise to improve aged care, and I guess, are there any I notice there's no retirement businesses there whatsoever.
Yeah, look, I think there's probably something in that. I mean, look, overall, I have to say, I don't necessarily think at the moment you'd go and bet your dollar on too many companies out there. I think that as time goes on and we get budgets and we see discrete spending initiatives, it might be easier to pick winners. But I think as I said, summary, healthcare, education, renewables, are all the Australian manufacturing. They're all the sectors that the government is going to want to spend more money in, and so there are companies that are going to do better over time as a result of the ALP government.
Okay, interesting time. Thanks for joining us, Paul. Paul Rickard of the Switzer Report. I'm catching up with Joe Masters, Chief Economist at Barrenjoey Capital, and with wages data out last week, really interested to see what she thinks is going to happen to both wages, inflation, and ultimately whether she sees a recession or maybe even the opportunity for the market to rebound later in the year. Joe, great to see you.
Great to be here.
Now, you are an economist, and I seldom pester economists to talk about markets, but you are working for Barrenjoey Capital.
Indeed.
So are you forced to have a view on what you think might happen to markets in the future?
We absolutely have a view for
Good,
for our
good,
clients,
good.
and
Yeah.
I've only been there a few weeks, so we're still building out all our forecasting framework, but very happy to talk markets.
Okay, right. We'll finish on that. That's the dramatic part. Let's set the scene, and the scene is really important to whatever you might say down the track at the end of this interview. Is that we got wage data this week. And I know my colleagues in the media were disappointed that it showed that the cost of living is going up and real wages are going down. But it's also very good for interest rates and inflation ultimately. So let's start off with that wage number. Do you think it's going to get bigger over the next quarter or two?
It's unquestionably going to get bigger. The uncertainty is the timing, a little bit like markets, right?
Yeah.
So we had the disappointing data. Wage growth was 2.4% in the year to the March quarter.
Yeah.
So a couple of things happening there. We know that the unemployment rate is very low. We know the labour market's very tight. 8 out of 10 firms are telling us they're having trouble finding suitable workers. So, where is wage growth? Well, the way that we set wages in Australia means that it takes a long time to feed through. So to put that in context, 20% of our workforce have their wage each year reset by the Fair Work Commission with the minimum wage.
Okay, 20%.
Effective on 1 July.
Yeah.
The Reserve Bank estimates another 20% of jobs in the workforce have a pay that is influenced by that minimum wage setting. So that's 40% of jobs that wait once a year for that ruling.
Okay.
We also know, and as you would know, lots of jobs in the private sector on private agreements are rebased and set for 1 July, the start of the new financial year.
Yeah.
So, I think we need to see this 1 July come so that we get these opportunities for those contracts to reset. Yeah. And I think when you get that, you will see a significant acceleration of wages.
That September quarter will basically
That's right.
show up. Okay. So, given that, what is your new house view on what inflation is going to look like by maybe September, October this year?
So inflation is going to stay elevated over this year. We think the peak will be somewhere in the high 5%.
Yeah.
So it's 5.1% in the March quarter. We've got, I guess those supply shocks are bigger and lasting longer than we thought.
Yeah.
I mean, in effect, if we hadn't had the floods and the Ukraine crisis, if you go back to the end of last year, we were actually seeing signs that some of that congestion in the supply chain was easing. Then we get hit by 2 more shocks. And now we've got China in lockdown, which is creating all that. So inflation to stay high this year. It doesn't keep going higher though. You know, we measure the rate of change in prices. So you get this shock that lifts the level and then it stays up there for a little while and then it starts to come down.
Yeah. They call it disinflation. It's still inflation, but at a lower rate.
That's exactly right.
Yeah.
And that's, I guess, that's the soft landing in the prices world, right?
Yeah. But I guess you'll be looking for the rate at which it falls to actually try to guess how many interest rate rises the Reserve Bank's going to do. So where do you lie on the... I love Matt Common's 1.6% cash rate by the end of the year. Go Matt, hope he's right. But economists, well, of course, he's talking the CBA view.
Sure.
Other economists have it a cash rate at 2.6%, which makes me feel a lot of people will be squeezed if that happens. What do you think, Joe?
So inflation's one element, but the other, as you just alluded to, is household debt. And one of the things that we don't know, because we haven't had a tightening cycle since 2010-11, is how do highly indebted households respond to that. On our own analysis, for what it's worth, when the cash rate gets above 1.25%, the proportion of disposable income going into mortgage interest payments hits levels that historically has seen consumption growth slow.
Yeah.
So that will cap how high rates
1.25%. Okay.
That's right.
Yep.
So
the Reserve Bank knows that.
well, I think they're uncertain. I mean, they're uncertain. Well, they know the history, but they're uncertain about the reaction function, right? We actually at Barrenjoey recently did a consumer survey. And we asked a whole heap of questions.
Big in the town, talking to consumers, wonderful.
We are, well, indeed. But you know what was really interesting is consumers can see what's coming, i.e. they can see rates are going up, but they underestimate how far and the likely impact on their budget.
Yeah.
And
that makes
actually,
sense. People don't understand those numbers,
That's right. So then you get there and all of a sudden you get this bit of sort of shock happening in the consumer sector.
Yeah.
So look, to answer your first question, we've got a series of rate hikes this year, 25 points in June and July, and then a few more. We also have a cash rate at 160 at the end of this year.
160,
But we've got a couple more in 1 to 2 more in next year, depending on the housing market.
But 160 is a lot better than 260, and some of them are saying 3. That to me sounds like recession bills coming down the pike.
I don't see how you can get to 3. I mean, even Governor Lowe has said that he is hopeful that the neutral rate is 2.5. You know, hopeful, right? And also, we've seen this long-term structural decline in the peak in cash rates or the terminal rate. The Bank of England did this work that goes back to 1300, and it shows 1300, and it shows this long-run structural decline. And each rate hike cycle, the peak gets lower and lower and lower.
Okay. 1300.
Yeah, it's a great chart. I'll send it to you.
Okay, great. All right, so on that, I guess the logical question now is, you think 25 basis points, that's what I was hoping for. I think Bill Evans has come up with 0.4.
Yep.
Michael Knox this week came out with a 0.5, which would take us to an unusual number like 0.85, but there's no reason why it couldn't happen. He reckons that Phil Lowe's copying the Fed in many ways, but we'll wait and see. I hope he's wrong.
I don't think you copy the Fed, but I think what happens in the global environment is relevant, is part of the decision making.
Yeah. So if the rate rises are bigger than you're expecting and we're expecting, do you think there's a good chance that a recession will happen?
It's quite hard to get a recession in Australia when commodity prices are so elevated.
Yeah, good point.
Right? So we could have, as we've had previously, a feeling of recession across the East Coast.
Yeah. Some states suffering.
Right?
Yeah.
But not the country as a whole. So again, the lucky country, we can go west and dig things out of the ground, may avoid it. You know, we're obviously talking about recession in the US, and one of the things I say to our clients is the US has lots of recessions, actually, quite frequent recessions. Its economy is more market-based, more nimble, more volatile. So just because we're talking about recession in the US doesn't mean we're talking about it here.
I shared this with my audio-visual team this week because, you know, they're young, of course. Audio-visual team should be young. I made the point that in the US, most people are on 30-year fixed interest rate home loans. And he was staggered, Andre. And And I said, but that's why our monetary policy works better here, because most of us are on variable interest rate policy. So does that actually, in a sense, give the Reserve Bank a chance to actually get their story right? Because that can affect a big chunk of borrowers. Compared to America, it's all the new borrowers and business that get affected.
That's right. So the RBA can affect new loans, but also the stock of loans. The other thing that gives the RBA a little bit more flexibility is they meet every month.
Yeah.
They have 11 meetings a year, right?
Yeah.
Whereas the Fed meets every 6 weeks. So I know that doesn't sound like a big difference, but it means that you can go by 25, 25, 25, and in the space of, 8 weeks or 12 weeks, make a really meaningful difference in the cash rate.
Okay, so let's force you into the area that most economists don't necessarily like to go. I twist Shane Oliver's name, but Shane does that sort of for MP. What do you think is going to happen to the markets? I'll give you my view, and then you can scoff it if you like. That I'm hopeful that the Ukraine war might get either settled by September, October, or we learn to ignore the war compared to the way we were shocked by it. And I used an example with a client today. I said, well, it's a bit like how we were shocked, Treasury of the United States was shocked when the tariff was put on, but now after a year, they've learnt to sell their wine differently, and they're even making wine in China. We probably could actually learn to live with a war, with oil prices not being as elevated. That's possible.
That's right. As we talked about before, that's the shock, and then you don't keep getting shocks on top of it.
Yeah, and also hopefully that China stays out of lockdown. So the two supply chain type forces on inflation by say September, October might be a lot less, and therefore I'm hoping that the market says, well, we overreacted, and the stuff that we sold off, those tech stocks, they were overbought in the first place, but now we've oversold them. We probably should start buying more. How realistic is that if we get the inflation scenario working out the way I'm guessing?
So I think that's a very plausible scenario.
She can come back.
But
oh, no, maybe she can't.
On the one hand, on the other,
Yeah.
that's a plausible scenario. But I think the risk is that even under that scenario, by the time you get to October and those inflationary pressures are coming off, two things have happened. The inflation genie's out of the bottle, and it gets harder to rein in. And we are, even in Australia, we've seen increasing number of firms reporting an ability to pass on costs. So once you've passed them on, you typically don't take them back, right? And this is after a decade or so where, as you know, Australian firms haven't been able to pass almost anything on, right? They've squeezed their margins. So that's possible. And then the other issue, I think, is what we're seeing in the US, where we're seeing a really rapid cooling of the housing market, and also the US consumer. You would have seen the US earnings this week. A whole heap of things happening
Walmart
there.
wasn't great, Target wasn't great.
But
Home Depot was.
So I think the level of activity in the housing market is quite high at the moment, and also in Australia, because we brought forward a whole lot of activity with Home Builder, but the pipeline looks terrible, right? But the interesting things in those earnings were, sales went up, but I'm just being squeezed by costs. And I can pass some on, but not all on. And also the very rapid move by the US consumer to down value. So I guess economists have been talking about this, war chest of savings that US consumers have and Australian consumers have. So I'm interested in the US to see how that plays out.
Does it become a real buffer?
Do they actually spend it? Or because of the Ukraine and talk of recession and rising rates, do I kind of hold on to those precautionary savings? And if you do, then your scenario around the supply shock may play out, but the actual economic recovery may not be as
Isn't it
strong.
funny, Joe, that in economics it's always nice when there are less curveballs, but the curveballs we've got now are extraordinary. You've got that household savings unbelievably high. We've got the fact that inflation remained unbelievably low because of the digital world. That meant it was very hard for people to raise prices. But at the moment, they may have a window of a year before people start rediscovering that there are people overseas who can do what's being done here. I know even the labour market, the people who want to work from home may well find that they'll be home without a job because someone in the Philippines will take their job. But that could take a year or so, and therefore that your scenario, that my view could be a little bit too early. But then if it all works through the system, we also have this rebound out of a lockdown, which has been put on hold in many ways. So because China will do it as long as they can overcome it.
Absolutely.
Do you think that could actually mean that 2023 could be the rebound that we were supposed to get in 2022, or will the rebound disappear?
I think you'll get a rebound in China. I mean, we've seen that all around the world.
Which is good for Australia economy.
Which is good for Australia, and actually just in the last 24 hours, they've talked about infrastructure as one of the levers that they've pulled, but could continue to pull, right? So, the commodity outlook, looks reasonably good. I guess my concern is actually that growth could look okay in 2022-23. But the headwinds are rising for 23-24.
Yeah, I agree.
So consumers run the buffers down, interest rates get to the point and maybe we overshoot and they really hurt the housing market and house prices start falling. Yeah. The residential construction cycle, we work through the pipeline and then we've added nothing to the pipeline. And even business investment, it's been very strong coming out of the recovery, and the Reserve Bank's forecasts have another lift up next year, but I'm less clear where that comes from. Yeah,
it's interesting. I did a speech for the Crane Association, and they're seeing they've got 5 years worth of work ahead of them. Now that's a really good indication, but a large chunk of it would have been government spending on infrastructure. The curveball will be what does the residential part do, and which you can't be as confident about that. You can be confident about what the government's going to spend because they've promised it, in a sense, as a recovery program. But, I guess it gets down to this final question. We really are in the hands of the central banks, aren't we? If they go too hard, they'll cause a recession. If they go too soft, inflation hangs around for too long. So eventually they'll have to raise interest rates and recession will be pushed down the curve, maybe to 2024.
Yeah, look, it's really hard. I mean, one of the lessons from the pandemic is the role of fiscal policy, right? And suddenly we're not too worried about deficits, apparently, right?
Yeah.
So the good news is that you can see a world where fiscal policy plays a more active role in cycle management. So that may help, although that's always got a political spin, so it doesn't always come at the right time.
No.
But for the central bank, I mean, this is the ubiquitous kind of soft landing. We want to bring inflation down just into the band, and we want growth to be just slow enough to get us there, but no weaker than that.
We're thinking Goldilocks here,
and
aren't we?
It's tough, right? And also a lot of the markers that we use in economics, as you know, are not observable. So we talk about, where's full employment? Well, we don't know where it is until we pass it. Where's the potential growth rate in the economy? You don't kind of know until you've passed it. And where's the neutral crash rate? So which it benchmarks whether you're expansionary or contractionary. Well, we kind of don't know where that is either. So
we don't know
it's
a lot.
tough. There's a lot we don't know. I think the pandemic showed that, right?
Yeah, without a doubt. And the pandemic has created more curveballs than we've ever had before, I think.
I mean, you and I have talked about the economy for a long time. I think now more than any other time in my career, there are more moving parts and more uncertainty within each of those moving parts, which ultimately leads to market volatility. That's how I see that.
Well, let's hope Barrenjoey pays you a lot more money because it's a lot harder job you're doing. Thanks for joining us, Jo.
Great to be with you.
That's Jo Masters of Barrenjoey Capital.